Welcome to History with Herodotus, where we delve into the fascinating tales of our collective past. Today, we embark on a captivating journey through the history of gold standard adoption, a monetary system that has shaped the course of global economics for centuries. As we traverse the complexities of this pivotal moment in human history, imagine yourself standing amidst the bustling streets of 19th century London, surrounded by the hum of commerce and the whispers of financiers. In the early days of international trade, the value of currencies was often tied to the value of precious metals, particularly gold. The concept of a gold standard, where a country's currency is pegged to the value of gold, began to take shape in the mid-19th century. To understand the events that led to the widespread adoption of the gold standard, we must first examine the economic landscape of the time. In the aftermath of the Napoleonic Wars, European nations found themselves grappling with the challenges of rebuilding their economies. The British Empire, in particular, had emerged as a dominant world power, with its currency, the pound sterling, becoming a widely accepted standard for international trade. However, the British economy was still reeling from the effects of the war, and the government was struggling to manage its debt. It was during this period that the influential British economist David Ricardo began to advocate for a return to a gold-backed currency. Ricardo's ideas, as outlined in his seminal work on the principles of political economy and taxation, would go on to shape the course of monetary policy for generations to come. He argued that a currency tied to the value of gold would provide a stable store of value, facilitate international trade, and prevent governments from debasing their currencies through inflationary policies. As the British economy continued to grow and expand, the need for a more formalized system of currency management became increasingly apparent. In 1816, the British government passed the Coinage Act, which established the gold sovereign as the standard unit of currency. However, it was not until the 1840s, with the passage of the Bank Charter Act, that the gold standard began to take shape as a formal monetary system. The Bank Charter Act, championed by the formidable Sir Robert Peel, introduced a number of significant reforms, including the establishment of the Bank of England as a central bank and the requirement that banknotes be backed by gold reserves. This marked a major turning point in the development of the gold standard, as it provided a framework for the widespread adoption of gold-backed currencies across Europe. As the Bank Charter Act of 1844 laid the groundwork for the gold standard, the subsequent years witnessed a flurry of activity as European nations began to adopt gold-backed currencies. One of the most significant events during this period was the establishment of the Latin Monetary Union in 1865, which united France, Belgium, Switzerland, and Italy under a single gold standard. This union facilitated trade and investment among member states, fostering economic cooperation and stability. The French franc, backed by gold, emerged as a leading international currency, rivaling the British pound. The late 19th century saw a surge in global trade, driven in part by the widespread adoption of the gold standard. As countries pegged their currencies to gold, exchange rates became more stable, and international commerce flourished. The United States, which had previously used a bimetallic standard that included both gold and silver, officially adopted the gold standard in 1879 with the passage of the Specie Resumption Act. This move marked a significant shift towards a more formalized monetary system, as the U.S. government committed to redeeming its currency in gold. The era of the gold standard was also marked by periods of economic turbulence, including the Panic of 1893 and the Boer War, which led to a surge in gold prices and a subsequent credit crunch. However, these challenges did not deter nations from their commitment to the gold standard. In fact, the early 20th century saw an increase in international cooperation with the establishment of the gold exchange standard in 1925. This system, championed by the British economist John Maynard Keynes, allowed countries to hold foreign currencies, such as the US dollar or the British pound, as reserves instead of physical gold. The interwar period was marked by a complex web of international agreements and monetary arrangements, including the Genoa Conference of 1922, which aimed to restore the gold standard in Europe. As the global economy struggled to recover from the devastation of World War I, the gold standard became a central issue in international economic policy. The British government, under Chancellor of the Exchequer Winston Churchill, returned to the gold standard in 1925, with Churchill famously declaring, "I will not be party to measures which will make the British consumer pay more for his groceries." This decision had far-reaching consequences, as it tied the British economy to the fluctuations of the global gold market. As the world teetered on the brink of economic collapse during the Great Depression, the gold standard came under intense scrutiny. The British government, facing mounting pressure to abandon the gold standard, finally succumbed in 1931 when it suspended convertibility of the pound to gold. This move marked a significant turning point in the history of the gold standard, as other nations began to question the wisdom of tying their currencies to the value of gold. The United States, under President Franklin D. Roosevelt, followed suit in 1933, abandoning the gold standard and embarking on a policy of monetary expansion. As the United States abandoned the gold standard in 1933, the international monetary system began to unravel. The collapse of the gold standard marked a significant shift towards fiat currency, where governments could print money without being tied to the value of gold. This transition had far-reaching consequences as countries began to experiment with new economic policies and strategies. The Bretton Woods Agreement of 1944, signed by 44 nations, established a new international monetary order that effectively replaced the gold standard. The agreement created the International Monetary Fund, IMF, and the World Bank, institutions designed to promote global economic cooperation and stability. The US dollar, backed by gold at a fixed rate of $35 per ounce, emerged as the de facto global reserve currency. However, the Bretton Woods system was not without its challenges. The 1960s saw a surge in international trade and investment, which put pressure on the US dollar and the gold standard that underpinned it. In 1971, President Nixon suspended the convertibility of the dollar to gold, marking the final nail in the coffin of the gold standard. As the economist Milton Friedman once observed, the gold standard is not a guarantee against inflation, it's a guarantee against hyperinflation. In the decades that followed, countries began to adopt floating exchange rates, where the value of their currencies was determined by market forces rather than being tied to the value of gold. This shift towards fiat currency and floating exchange rates has had a profound impact on the global economy, allowing governments to implement monetary policies tailored to their specific needs. Today, the gold standard is remembered as a relic of a bygone era, a quaint reminder of a time when currencies were tied to the value of precious metals. However, its legacy continues to shape our understanding of international economics and the role of government in managing the economy. As we navigate the complexities of our own economic era, it is essential that we draw upon the lessons of the past, recognizing both the benefits and limitations of different monetary systems. That's all for today's History with Herodotus. Remember to like, share, and subscribe, and until next time, remember that, to understand the present, we must first understand the past.